Hello and welcome to an episode of THP Tutorials. This episode will begin the series on management accounting for business. To kickstart the series, this episode will talk about the nature of management accounting by giving an introduction into the discipline of management accounting, the purpose and role of management accountants inside a firm, management accounting information, and as well talk about the influence management accounting has on decision making inside of a firm. Before we get down to business, please be sure to hit the subscribe button and turn on post notification in order to get notified when the next episode in a series is uploaded. Thank you. An important question to begin this episode would be, what is management accounting? Before we define management accounting, let's isolate the two words making up the concept and define those as well. So, other questions worth asking would be, what is management and what is accounting? Now, according to Bartol and Martin, 1996, management is the process of achieving organizational goals by engaging in the four major functions of planning, organizing, leading, and controlling. The American Accounting Association, AAA, defines accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of the information. There are two major branches of accounting: financial accounting and management accounting. Whereas financial accounting deals with providing information to external users, management accounting focuses on internal users. Management accounting is a branch of accounting that deals with providing confidential financial reports for the exclusive use of top management. Management accounting measures and reports financial and non-financial information that helps managers to make decisions that will enable the firm to achieve its goal. Management accounting deals with information that is not generally disseminated outside a company, such as salary cost, profit targets, and cost of materials per unit produced. This is a fair idea on what management accounting is all about. The next thing this chapter will look at is the purpose of management accounting. The primary role of management accounting is to provide information in a timely manner to the company's relevant management to help them plan and control the activities of the organization, and with which optimal and sound decisions can be made. The main purpose of man accounting can be summarized as planning, controlling, and decision making. Let's talk more about these three. Planning. Planning involves establishing the objectives of an organization and formulating relevant strategies that can be used to achieve those objectives. In order to plan or budget, we need to know what has happened in the past so that decisions about what is achievable in the future can be made. Planning can be thought of as looking forward. If that is the case, then controlling can be said to be looking back. Why the need to look back, you ask? Well, that's the only way to know whether you have strayed from the desired path or not. Controlling is simply monitoring actual performance and comparing it to the desired or planned performance in order to identify gaps and find a way to close said gaps or to correct mistakes made. And then we have decision making. Decision making process encompasses both planning and controlling. It involves considering information that has been provided on various alternative courses of action and selecting the appropriate course of action for implementation. Management accounting recognizes that managers need reliable information to compare the different courses of action available and understand what the consequences might be of choosing each of them. This is what management accounting is for: planning, controlling, and decision making. Earlier in this episode, we learned that there are two branches of accounting. Let's take a look at how these branches differ from each other. The differences between man-accounting and financial accounting will be discussed in terms of their respective uses, coverage, legal requirements, timing, and reporting frequency. Let's begin with the uses of both. In terms of uses, management accounting provides information to people within an organization, i.e., internal users, while financial accounting is mainly for those outside. For legal requirements, financial accounting is required by law, while management accounting is not. Specific standards and formats may be required for statutory accounts, such as the International Financial Reporting Standards. Financial accounting must comply with various accounting standards, whereas managerial accounting does not have to comply with any standards when information is compiled for internal consumption. Coverage. Financial accounting covers the entire organization, while management accounting may be concerned with particular products or cost centers within the organization. Financial accounting concentrates on the production of financial reports, including the basic reporting requirements of profitability, liquidity, solvency, and stability. Reports of this nature can be accessed by internal and external users, such as the shareholders, the banks, and the creditors. Time period. Financial accounting is concerned with the financial results that a business has already achieved, so it has a historical orientation. Management accounting may address budgets and forecasts, and so can have a future orientation. Timing or report frequency. Financial accounting requires that financial statements be issued following the end of an accounting period. Managerial accounting may issue reports much more frequently, since the information it provides is of most relevance if managers can see it right away. Up next, the functions of a management accountant. Who is a management accountant? According to the Institute of Certified Management Accountants, ICMA, a management accountant applies his or her professional knowledge and skill in the preparation and presentation of financial and other decision-oriented information in such a way as to assist management in the formulation of policies and in the planning and control of the operation of the firm. Management accountants, therefore, are seen as the value creators amongst the accountants. They are much more interested in forward-looking information and taking decisions that will affect the future of the organization than in the historical recording and compliance aspects of accounting. It is clear at this point that management accounting plays a huge role in a firm. Let's look at how management accounting impacts decision-making mechanisms inside a firm. In management accounting, decision-making may be simply defined as choosing a course of action from among alternatives. If there are no alternatives, then no decision is required. The basic assumption is that the best decision is the one that involves the most revenue or the least amount of cost. The task of management with the help of management accountant is to find the best alternative. Hence, management accounting facilitates decision making inside of a firm. The process of making decisions is generally considered to involve the following steps. 1. Identify the various alternatives for a given type of decision. 2. Obtain the necessary data needed to evaluate the various alternatives. 3. Analyze and determine the consequences of each alternative. 4. Select the alternative that appears to be best to achieve their desired goals or objectives. 5. Implement the chosen alternative. 6. Evaluate the results of the decisions against standards or other desired results. Knowing that the information from management accounting is used to make decisions in a firm, let's have a look at the nature of such information and the qualities such information should possess. Characteristics of management accounting information. When taking decisions, management need the right information to enable them evaluate the various alternative courses of action accurately. The information must possess the following characteristics or qualities to make it useful. 1. Accuracy. Information must be accurate. It must be free from error or material misstatements. The degree of accuracy depends on the reason the information is needed. For example, reports may show figures to the nearest 1,000 Ghana cedis or to the nearest 100,000 Ghana cedis for a report on the performance of different divisions. Alternatively, when calculating the cost of a unit of output, managers may want the cost to be accurate to the nearest cedi or even pesos. 2. Complete. Managers should be given all the information they need, but information should not be excessive. For example, a complete control report on variations should include all standard and actual costs necessary to understand the variance calculations. 3. Cost beneficial. The value of information should not exceed the cost of producing it. Management information is valuable because it assists decision making. If a decision backed by information is different from what it would have been without the information, the value of information equates the amount of money saved as a result. Understandable. The use of technical language or jargon must be limited. Accountants must always be careful about the way in which they present financial information to non-financial managers. Relevant. The information contained within a report should be relevant to its purpose. Redundant or repetitive parts should be removed. Authoritative. Information should be trusted and provided from reliable sources so that the users can have confidence in their decision making. Timely. Information should be provided to managers on time for them to make decisions based on that information. Easy to use. Management accountants must always think about the person using the information they provide and make sure the information meets their needs. That's it for the qualities of management accounting information. Now, at various management levels, information needs are different. Let's talk more on this. There are 3 levels of management: strategic, managerial, and operational. Information needs differ at each of these levels. For the strategic level, management needs to know about developments in their markets and the economic situation in their area of operation. They also need to know about any new technology that emerges and about the activities of competitors. Decisions made at this level will have a large impact on the whole organization, will be long-term, and will tend to be unstructured. At the managerial level, management at this level might want to know about issues such as product or service quality, speed of handling customer complaints, customer satisfaction levels, employee skills levels, and employee morale. Decisions made at this level will have a medium impact on the whole organization, will be medium term, and will act as a bridge between the strategic and operational levels. For the operational level, management may want to know about the number of rejects per machine, the lead time for delivering materials, and the number of labor and machine hours available. Decisions made at this level will have a small impact on the whole organization. They will normally only affect one business unit or department. They will be short term and they will tend to be highly structured. This concludes the first episode in the series. To summarize everything, we have learned about introduction to management accounting and financial accounting, functions of management accountants, management accounting and decision making, information for different levels of management, and the purpose of management accounting. Thank you for watching. Please do not forget to like and subscribe for more episodes. If you found this episode helpful, kindly drop a comment and give a thumbs up. Please share as well. I'll see you in the next episode. Don't forget to subscribe. Thank you.